Is the housing market going to crash? I get asked this question every single day and everyone has an opinion, but almost nobody actually studies the data. So I went back and analyzed every major housing crash in US history, from the 1920s Florida land boom to the 2008 financial crisis. And here's what I found. Every single crash had 5 warning signs in common, and 3 of those warning signs are flashing right now. In this video, I'm breaking down all 7 crashes, showing you the patterns that repeat every single time, and explaining whether we're heading for another crash, or if this time it's actually different. Hey, I'm Tanner Litchfield. I've closed $50 million worth of real estate transactions in the last 36 months. I own 14 rental properties, and I've studied market cycles obsessively because timing matters when you're deploying as much capital as I tried to in the real estate industry. So let's dive into the history. Let's start with the first major housing crash in American history, the 1920s Florida land boom. In the early 1920s, Florida was the hottest real estate market in America. Sound familiar? Land prices were up 1,000% in some areas from 1920 to 1925. Speculation rampant. People buying land sight unseen. The leverage, buyers were putting 10% down, flipping before closing. New residents, there are 2 million people who moved to Florida. This was the original everyone's moving to Florida story. Developers were selling swampland as waterfront property. People were buying land they'd never seen based on literal brochures. And then in 1926, it all collapsed. The trigger, a hurricane destroyed Miami. The price decline was 50 to 70% in most markets. And the duration, prices didn't recover until the 1940s. Banks failed. Hundreds of banks collapsed. The warning signs were obvious in hindsight. Excessive speculation, extreme leverage, people buying based on hype, not fundamentals. But that was just the beginning. Because 3 years later, the entire American economy collapsed and housing got destroyed. Let me show you. The Great Depression wasn't just a stock market crash. It was a complete economic collapse, and housing indeed got destroyed. Home prices were down 30 to 40% nationally. And from 1929 to 1933, the foreclosure rate was 10% of all homes, which is insane. The unemployment was 25% at its peak, and construction dropped 95%. The recovery time, 15 plus years to return to 1929 prices. But here's what most people don't know. The housing crash was caused by a credit contraction. Banks failed. Mortgages were called due. People couldn't refinance. They were stuck. The warning signs before the crash were excessive stock market speculation, easy credit and leverage, overbuilding in major cities, affordability at extremes, and the wealth inequality at all-time highs. Sound familiar? We'll come back to that. But the Great Depression wasn't the last time the housing market crashed. In the 1980s, over 1,000 banks failed in what's called the S&L crisis. 1,043 banks collapsed, to be exact. Home prices were down 20 to 30%, $124 billion worth of taxpayer bailout. The trigger, oil prices crashed. The Texas economy collapsed, and over-leveraged banks went under. But the biggest crash of our lifetime was still to come. This is the crash everyone remembers, and it was brutal. Home prices were down 33% nationally. Foreclosures. There were 10 million homes that went into foreclosure from 2007 to 2016, and unemployment was at 10%. The markets hit hardest were Las Vegas, which were down 62% in value, Phoenix at 56%, Miami 51%. The recovery time was 6 to 8 years before it returned to the 2006 prices. My mentor told me the story that stuck with me a lot throughout the years when it comes to real estate, and he told me that he almost bought a property in Phoenix in 2006, right before the crash. Now, his mentor told him to wait because he saw the warning signs. And my mentor didn't listen, and from that deal, he lost over $200,000. Ever since then, I've been trying to study these patterns way more obsessively because of what my mentor went through. But here's what caused it. Subprime lending. Anyone could get a mortgage. If you've seen the movie Big Short, you know why. No doc loans, ninja loans, no income, no job, no assets, adjustable rate mortgages with teaser rates, Speculation. People were buying 5+ investment properties and they could not even afford it. Wall Street was packaging these bad loans as AAA securities, and leverage was insane. The mentality was housing never goes down. People were buying homes they couldn't afford, planning to flip them in 6 months. And then the music stopped. When prices started falling, it triggered a cascade. Homeowners were underwater, they stopped paying, banks foreclosed, which flooded the market with inventory, and there was more supply, so prices fell even further. More people being underwater meant more foreclosures. It was a death spiral. So now that we've seen all the crashes, let's talk about the patterns. After analyzing all 7 of these crashes, here are the 5 things they all have in common. Number 1, excessive speculation and leverage. Every crash was preceded by a period where people were buying not to live in, but to flip. They were using maximum leverage. They were treating housing like a casino. 1920s in Florida, people buying land sight unseen, margin buying stocks and real estate. In the 1980s, S&Ls were making risky commercial loans. 2008, ninja loans and subprime lending. Number 2, credit expansion followed by contraction. Every crash followed the same pattern. Credit becomes easy, prices rise. Credit tightens, prices fall. This is the most important pattern. When banks are lending freely, prices go up. When banks stop lending, prices crash. Number 3, affordability reaches extremes. Before every crash, housing affordability hit extremes. The median home price to median income ratio went above 5-to-1. When housing costs cost more than 5 times the median income, something has to give. Every crash involved overbuilding. In 1920s in Florida, the developers were building on swampland. In 1980s, commercial real estate, they were overbuilding like crazy. And in 2008, subdivisions were in the desert with no buyers to be found. Buyers always overbuild at the top. It's human nature. When prices are rising, everyone wants to build. Remember, we need all 5 patterns, not just 3. So now the big question, are we seeing these patterns today? Let's go through the 5 patterns and see if they're present today. Pattern number 1, excessive speculation and leverage. Investor purchases were 27% of all sales, which is high, but not quite 2008 levels. Leverage. Lending standards are much tighter now than they were in 2008. The verdict, I think there's some speculation, but not quite as extreme as other crashes. Pattern number 2, credit expansion followed by contraction. 2020 to 2021, credit was super easy and rates were at 3%. 2022 to 2024, credit tightened and rates are now 6% plus, almost double. The verdict, we've had the expansion and the contraction cycle. Pattern number 3, affordability at extremes. Median home price to income ratio, 5.8-to-1, which is the highest ever. Monthly payment as a percentage of income is 35% plus, which is the highest since 2008. The verdict, affordability is 100% at extreme highs right now. Pattern number 4, oversupply. Housing inventory still below historic norms. New construction is not being overbuilt except luxury apartments, and we are actually in an undersupply of affordable homes. The verdict, we are not in oversupply in most markets. In fact, a lot of people say that we need to build more. Pattern number 5, external economic shock. Possible triggers, recession, unemployment spike, geopolitical crisis. The verdict, no shock yet, but risk does exist. Patterns present, I'd say 3 out of 5. In the risk level, I'd say moderate. So here's my take. We have some warning signs, but not all of them. And the biggest difference between now and 2008 is the lending standards. In 2008, anyone could get a mortgage. Today, you need good credit, income verification, and a down payment. That doesn't mean we can't have a correction, but a 2008 style crash, unlikely. So what should you do with this information? Here's how to think about it. If you're buying, don't panic about a crash. Seriously, don't overpay either. Focus on the fundamentals, cash flow, location, long-term hold. Have a 5 to 10 year timeline. Don't stretch your budget more than you need to. Now, if you're selling, don't wait for prices to go higher. If you need to sell, sell now. Markets are cooling, but they're not crashing. If you're investing, look for value, not speculation. Avoid super overheated markets and have reserves safe for a downturn. I'm still buying, but I'm being selective. I'm focusing on Utah, which I am extremely bullish on the future. I'm not overpaying, and I'm making sure that every deal cash flows from day one. But here's the truth. Nobody knows when the next crash will happen. Not me, not the best economist, and definitely not your uncle who called 2008. People have been predicting a market crash since 2019, and they've been wrong for 6 years, and they've missed out on massive gains. Don't make decisions based on fear. Make them based on data. Use this historic perspective to make informed decisions, not emotional ones. If you want to learn how to analyze deals and build wealth in real estate in any market cycle, make sure you hit that subscribe. I post lots of videos like this every single week. I'll see you on the next one.